STBB. And today's session is all about tax season and your taxes and property transactions. So if I sound a bit under the weather, I am. And Maan is also, so you're going to have to excuse us if there's a bit of a cough or something in between. We're going to try our best to manage it. I'm sure everyone has had the starting to get the flu now this time of the year. So anyway, so without further ado, like I said, we're going to start with today's session being all about taxes and your property transactions. Maan is going to be our host. Just a few house rules for today's sessions. Please make sure that you mute your mics and remain muted. If it's possible at the end, we can also look at unmuting and asking the questions if they're too complex. The presentation slides will not be shared after the session. However, we will be sharing our notes and you can also find our brochures and the recording of the session that we will be sharing afterwards. Please, throughout, you're more than welcome to share your comments, your questions, queries, anything in the chat box. We're going to manage them and collate them, and at the end, we're going to open up the floor for the questions for Maan to get to them. Those that we can't attend to, we will also just drop the answers to them and share with you afterwards, after the webinar. So any administrative queries, you're more than welcome to email marketing1@stbb.co.za. So that's anything about the query, about the recordings, anything like that. Maan's details is tax@stbb.co.za, but we'll share all of that with you in the chat box as well. You will be getting a certificate of attendance for this. So the certificate plus the notes and the recording, everything will be shared with you within 48 hours after the session. So you can look out for it early next week. And that's basically all the house rules that I wanted to get to. Just a little disclaimer, remember that this is only training material. You still need to seek advice if you've got a specific query, and this is really only for training purposes. Now, without further ado, I'm going to introduce to you Abdurrahman Farah. So Abdurrahman is our tax expert at STBB and works in the tax law department. He's also launched his career in SARS, so he has had a lot of experience both on SARS side and on the law side. So you're more than welcome to post all your queries to Maan to address. So without further ado, Maan, over to you.
Thank you for that, Leonie, and good morning, everyone. And thank you for joining us today as we discuss our tax webinar. So initially, we were going to recap on the tax budget, and look at the key concepts that was addressed during the budget speech. However, since it was nominal and there wasn't significant changes to the tax aspects in particular, we've decided to branch out and to touch on a couple of things we believe you should know as you're preparing yourself to file your tax returns. And this will help you to make sure you reap the best benefit or the tax benefit that's available for you. I always start my presentation with the saying, this lovely saying, that there's two things in life you cannot escape, and that is death and taxes. And that's absolutely accurate. Whether you manage to escape it now, manage to avoid paying taxes now, be sure that SARS will get the taxes on your date of death. So when we look at what was discussed at the budget speech, or the key takeouts from the 2024 budget speech, it is essentially nominal. There's nothing substantial. Most of the stuff remains the same as last year. There's few changes, but it does not impact the general person. That's more for businesses, commercial transactions, etc. No inflationary adjustments have been made to the personal income tax brackets, tax threshold, tax rebates, or medical aid credits. This is expected to raise additional tax revenue of 18.2 billion for the next tax year, which starts tomorrow. above inflation adjustments have been made to excise duties and alcohol and tobacco products. As you know, that is called the sin tax, and that is essentially where SARS collect most of the taxes. And for the whiskey drinkers, the vodka, gin, it's going up by 5 rand, 5.53. So it's 5 rand basically, it's going up. You can say it's 6 rand. For bottle of wine is going up by 28 cents, and for a can of beer, 14 cents. So to the drinkers out there, prepare yourself. You are going to pay much more for that drink. I think it's best during COVID. I see there was an uproar about how people started doing the plum wine at home, where they used to buy the pineapple sugar. I think that would be your next recourse, as the alcohol is certainly going to be expensive going forward. There has been no change that's been made to the general fuel levy and the road accident fund levy as well. The interesting change that came about in the budget speech was the two-pot retirement system that will be implemented from the 1st of September 2024, and they are estimating that it will approximately introducible make up a revenue of 5 billion. This two-pot retirement system was something that was in discussion for a while, and given the fact that they are trying to prevent people from taking out loans, etc., to cover debt in an emergency, they now legislated and are going to introduce a two-pot where your contribution to your retirement, this is going to go into two parts. It's going to be for your retirement and savings. What this means is that you can tap into your savings during your lifetime, and your retirement part will remain untouched. And how SARS is going to raise taxes in this instance is that when you tap into that savings, you will be taxed in accordance with the prescribed tax tables. And I'm going to show you, I'm going to give you an example of how this is going to be taxed, the pre-retirement and the post-retirement. So you will be able to tap into that and to get cash or liquidity to attend to certain things, which I believe is quite a nice introduction from the tax side, as people used to struggle to deal with or went into additional loans, etc., to cover the expenses. Now they have that retirement, that saving spot that they can tap into now. So basically, in a nutshell, the individual and special trust tax table remains the same. As you can see on the screen, it's a very complicated table to explain because the formula is actually backwards. But that is essentially how you will be taxed in terms of your taxable income for the year. That is unchanged, and any taxable income below the 18%, or well below 237,100, that remains taxable at 18%. But there's also a tax threshold, which is now number 2. If you look at the tax threshold, you will see, sorry, I'm just trying to move this. You will see that the tax-free threshold for personal income taxes have not been adjusted for the 2024-2025 financial year. It remains the same as last year, which is 95,750 rand for taxpayers younger than 65. That amount, if you earn less than that amount, that is not taxable, and it goes according to the high age category, and the amount increases. So the older you get, the higher your tax-free threshold is. Then we get to the standard rebates, which also remain unchanged. And that is essentially, a lot of people don't know this, but you are entitled to a rebate when you submit your tax returns. This is automatically generated by the system of SARS. And this rebate is for individuals younger than 65. It will be 70,235 rand. Above 65 is 9,444 rand, and then you get your age category above 75, which is 3,145 rand. So that is rebates that people are not really aware of. It is a rebate that is taken into account when your ultimate tax liability is calculated. Then the medical tax credits for those who have medical aid, the medical tax credits remain the same. A lot of people have wondered, sometimes they say SARS paid. I hear that this a lot. where people like, oh no, SARS paid me for being a good taxpayer. No, SARS did not pay you for being a good taxpayer. That's not why you got a refund. You got a refund because of one of these rebates. And in most instances, from my experience, the rebate stems from the medical tax credit. When you have medical aid, there is these 2 tax credits that's available for you, and that often results in you ending up getting a refund from SARS. SARS is not compensating you because you pay your taxes. You are basically overtaxed and you're entitled to that because of the rebates that exist. Capital gains tax remain unchanged. For individuals and special trusts, it's 18%. I just want to touch on this particular topic of 18%. Please note that you are not taxed at a flat rate of 18% for capital gains tax. Capital gains tax is not a separate tax. And a lot of people, when I discuss with them capital gains tax, they will tell me it's 18%. It is not 18%. It is, the minimum is 18%. As you see, the first tax table, it starts at 18%. With capital gains tax, it is not a separate tax. It forms part of your taxable income. So once you have calculated your taxable income, your capital gains tax, that is added to your taxable income for that tax period. And then it depends on which bracket you will fall in. So you can either fall into the first bracket of 18%, or you can fall into the bracket of 45%. Whereas with companies and trusts, they tax at their flat standard rate. You will see that often SARS or whoever speaks about tax, they will say a company pays tax at 21.6%, this and a trust at 36%. This is not the case. It looks that you're paying less tax for your capital gains tax, but in actual fact, that 21.6% is calculated in a specific way. When you calculate which we'll get later to in the presentation, when you calculate your capital gains tax for a company's inclusion rate for capital gains tax is 80%, and that 80% times the company's marginal tax rate, which is 27%. If you times 80% times 27%, it actually gives you 21.6%. So it looks like your capital gains tax is less, but in actual fact, it's just a very particular formula that was created to give you a flat rate number as 21.6%, but which is not the case. The same with trust. Trust is still taxed at a marginal flat rate of 45%. It's not 36%. It's 80% times 45%, which results in a 36% category. Trust is still taxed at the flat rate of 45%. A lot of people deem trust to be a great vehicle. Yes, after great consultation and consideration, a trust can be a very good vehicle to use from a tax perspective. However, you need to look and consult and see what is the purpose. Why are you creating this trust? Because a flat rate of 45% is quite steep. And just creating a trust for the sake of having one and thinking that it will have tax benefits, you need to assist on a case-by-case basis. And we have a trust department. You can contact them. Kelly Leach, Kelly L at stbb.co.za. It's trust@stbb.co.za. Should you wish to create a trust, you certainly please contact them. And then interest rate exemptions that remain unchanged as well. The local interest rate exemption remain unchanged for South Africans. The exemption on interest earned for individuals younger than 65 years remains 23,800 per annum. The exemption for individuals above 65 years and older remains 34,500 per annum. Foreign interest remains fully taxed. So if you're foreign online, you're receiving interest, it is fully taxable. You are not entitled to these benefits that South Africans are entitled to. Dividend tax. Dividend tax remains at 20% on dividends paid by residents and non-resident companies for shares listed on the JSE. foreign dividends received by individuals from foreign companies, shareholders of less than 10% in the foreign company are taxable at a maximum effective rate of 20%. Interest in respect of withholding tax for non-residents. We will touch on this topic later as well as we discuss withholding tax in terms of disposal of immovable property by non-residents. But interest withholding tax remains at 15% on interest from a South African source payable to non-residents. Interest is exempt if payable by any sphere of the South African government, a bank, or if the debt is listed on the recognized exchange. Tax-free savings, we all know about the tax-free saving accounts that many banks, all the banks offer. The annual cap on contributions to tax-free savings accounts remains at 36,000 from 1st of March 2024, with the lifetime limit also remaining at 500,000. So there is, it seems like you get a tax-free savings. It is not unlimited. There is a cap on this particular tax-free savings account. Earlier, I touched on the the two-pot. That two-pot will be taxed both separately, and it is essentially pre-retirement and at retirement. At retirement, the first 550,000 of retirement lump sum remains tax-free. So at retirement, that amount remains tax-free. That is particular table, like I said, is very difficult to explain the formulas because SARS formulas is backwards. It's not, you will calculate it as is there, but however, it's actually a backwards formula. Then pre-retirement, which is what you will tap into during your lifetime before you reach retirement. As we discussed earlier on, the first 27,500 of the pre-retirement lump sum withdrawal remains tax-free. So that is a tax-free lump sum. Other than that, any amount above that, you will start paying tax according to the rate as set out by SARS for lump sum. Value-added tax remained at 15%. There was some discussions coming up to the budget speech that they will most likely increase the value-added tax. And lucky for South Africans, it remained the same. South Africans is actually lucky because in other countries, value-added tax is up to 18%. When we look at estate duty is levied on property of residents and South African property of non-residents, less allowable deductions. The duty is levied on the dutiable value of an estate at the rate of 20% on the first 30 million and a rate of 25% above 30 million. A basic deduction of 3.5 million is allowed in determination of an estate liability. For the estate duty, the tax rates and the deduction remain unchanged from the last year. So estate duty also remained unchanged, no changes to this. It's very important that you do estate duty, estate planning. And once again, if you do wish for a will or want to do estate planning, please contact estates@stbb.co.za. This is important that you sit and you look at your assets and you plan your estate because estate taxes, estate duty can be quite steep. And if there's no liquidity in the estate, the beneficiaries will need to pay in. So be proactive, consult, get your will, contact estates@stb.co.za for assistance with that. Donations tax, the interesting topic that I often get questions from internally and externally. Donations tax also remained unchanged. It's 20%. The thing about donations tax that people don't get is that if a non-resident donates to a South African, there's no donations tax. The act in the section dealing with donations tax is quite explicit that it is residents. So it refers to the term resident. If you, and because it's in the Income Tax Act, we are speaking about a resident for tax purposes. There's always a confusion around, am I a resident because I have a green barcoded ID, I have a tax number? The question that you need to ask yourself, am I a resident for tax purposes in South Africa? And a reason for tax purposes in Africa, there's two ways of looking at it. It's the ordinary residence test and the physical presence test. It's very complicated to determine that, especially when you work from the conveyancing aspect. where the client tells you, I have a tax number, you often believe that I'm dealing with a resident for tax purposes. It doesn't mean that the reason why, the fact that I have a green barcoded ID and that I have a tax reference number, that I'm a tax resident. There is a specific criteria that you look at, and I often tell people the easiest way to establish whether you're a tax resident is to look at, do I pay tax on my worldwide income to SARS, or do I pay tax just on income from a South African source? Whether you require to is something different, but if we're dealing with a matter and we're trying to establish, we will look at that, especially from a conveyancing perspective. Do you pay tax? Simple question often asked, do you pay tax to SARS on your South African income alone or on your income that you receive worldwide? Reason for that is in 2001, South Africa moved from a source-based to a resident-based tax system. That means that if you're a tax resident in South Africa, you are going to pay income tax on your income on your worldwide income, whereas a non-resident will pay tax only on an income which they derive from a South African source. To give an example of a non-res, that would be a non-resident owns a property in South Africa. He only visits once a year. The rest of the year, he's renting the property out. That's the only income that he receives is from renting out that property. That is considered rental income. The non-resident will be required to receive a tax and pay tax on that income. That was the only income that he will pay tax on because he is a non-tax resident. So in a nutshell, sorry, I just deviated substantially, but donations tax, if a resident donates, there is donations tax. When it's a non-resident to a South African, there is no donations tax. Okay, so now that's essentially a recap of the budget speech. So we're going to go into a couple of tips for you to look at or to take into account while you prepare for the filing season coming up later this year, or if you're a provisional taxpayer, that should have taken place. Today's your last day. So we're going to look at a couple of tax tips just to make sure that you get up and you know what's coming and you don't get one of those credit letters from SARS or a rejection or even a penalty or fine for submitting incorrect documentation. You don't want to go through the ADR process. So it's of utmost importance that you actually prepare yourself and know what you can claim, what you're supposed to produce, and what you are entitled to receive. Okay, the first thing we're going to look at is, which was something that a lot of people coming from experience working at SARS, I decided the four things I'll be speaking about is based on my experience as to what people often don't know or what they fail or where SARS rejects their claim and they end up losing out on this actual benefit. So one of it is additional medical tax credits. So what is additional medical tax credits? Initially, I spoke about the medical tax credits that each person is entitled to if you have medical aid, but you're also entitled to additional medical tax credits, which is often regarded as out-of-pocket medical expenses. These expenses are essentially, if you go, often you find, we have medical aid schemes where they say, okay, this is not included, we're not covering this, or I had to pay an additional fee or cost. That is what is considered to be out-of-pocket medical expenses. It is expense incurred for for certain medical treatments, medication, etc., which your medical aid did not cover, and you cannot claim it from any other source or gap, etc. So if you want to make use of additional medical tax credit rebate, you are required to show that it was not refundable. So what are the regarded as qualifying medical expenses? These things typically include services rendered and medicines supplied by any duly registered medical practitioner, dentist, optometrist, etc. The list continues, but the focus there is duly registered medical practitioner. If my friend is final year medical student and he gives me a prescription or not prescription, but he advised me I can, and he gives me an invoice, I cannot. He's not duly registered as of yet. So the focus there is whatever expense it is, it needs to be expense that stems from a duly registered medical practitioner. If you're hospitalized in a registered hospital or nursing home, your focus was SARS. And when a lot of people don't get to enjoy these benefits or these rebates, deductions, is because they do not take into account the finer requirements. So you see, okay, it's a person will read the act or will read the article and say services rendered and medicine supplied by a registered medical, duly registered medical practitioner tenders. If that person is not duly registered, SARS will reject it. So the same with the hospital or the nursing home, nursing by a registered nurse. So the focus there is the registered nurse, a midwife or nursing assistant. You always need to look at it. They need to be registered. It cannot be somebody that's not registered. I've often seen people make use of somebody that is assisting at home with their mother or father. If they're not registered, you cannot claim this benefit. There is a long list of other expenses that can be incurred that is set out by the commissioner. This is related in respect of disabilities, etc. It's an extensive list. And if you wish for me to share that list with you, please just email me and I'll gladly share that with you. So this is basically what is regarded as qualifying medical expenses in order for you to make benefit from this additional medical tax credit. And often we find that your father have you on the medical aid. Yes, if you incur those medical expenses, additional medical expenses, he incurred it, he will be able to claim it. But there is a very strict requirement as to what is a dependent. It is either a spouse, a child, and the child of a spouse, who was not just the child of a spouse, but it continues, who was alive during any portion of the year of assessment, and who on the last day of the year of assessment, which would be today, 28th of February, was unmarried and was not or would not had he or she lived have been older than 18, older than 21 years, and was entirely or partly dependent for maintenance on the person and has now become liable to pay normal tax for the year, older than 26 years and was entirely or partly dependent for maintenance on the person and has not become liable to pay normal tax for the year and was a full-time student at the educational institution of a public character. In the case of any other child, was incapacitated by a disability from maintaining himself or herself and was entirely or partly dependent for maintenance on the person and has become liable to pay normal tax for that year. So you can see from the criteria, it's not just a dependent. There is sub-criteria that you need to comply with. If you're lucky enough and you're still on your parents' medical aid, and for some reason they are able to retain you and you are on the medical aid, they pay for the medical aid, but you became liable to pay tax. You actually work and you pay tax, you're taxpayer. Your father will not be able to claim the additional medical tax credits in respect of you because you're liable to pay tax. You're a taxpayer. So that's basically a nutshell of the additional medical tax credits. Let me just go back. If you wish to claim your additional medical tax credits, please make sure that you have documentary evidence. In terms of the Tax Administration Act, it is clear that any taxpayer who wishes to make use of a deduction, claim a deduction expense, they bear the onus of proving they incurred that expense. So if you have incurred any out-of-pocket medical expenses and it qualifies, you need to produce and submit to SARS that invoice, that statement, that prescription that stipulated that you incur that expense. Please note that if you go to the pharmacy and you buy painkillers, you will not be able to claim it as an out-of-pocket expense, medical expense. That was not prescribed by a registered practitioner. It is something that you just wanted, so you cannot claim that back. So while you were working towards filing season, I advise you to start collecting those invoices and those prescriptions, gather them together, get your things in order. It will make your life much easier. With SARS, whenever you deal with SARS, whenever you wish to claim, make use of a rebate or claim a deduction, you bear the onus. And to prevent going back and forth with SARS, submit all your supporting documents, because either they're going to request and ask for additional documents, or they're going to reject the matter, and then you need to follow the objection route, which is another couple of days. And if that objection is not accepted or approved, then you need to go to the ADR appeal route, which can take a couple of months. So I would advise gather all the necessary information, prepare yourself with tax filing season coming up. You need to gear yourself, because once you receive that letter for additional documentation, it's just going to drag out every single thing. So now we're moving on to travel expenses. Sorry, let me just move this here. When can you claim travel expenses? Often you have people that's on the road that travels a lot for work, etc. They incur these expenses. So there's certain instances where you can claim these travel expenses, but from my experience, most people that claim these travel expenses don't get that because they don't keep proper record. If you receive a travel allowance from an employer or principal, you can claim a deduction on assessment of your annual income tax return for the use of your private motor vehicle for business purposes. Yeah, I've seen a lot of people now use their personal vehicle for business purposes. There's wear and tears, all those additional things, and they receive allowance for this from the employer. You can claim travel expenses from SARS, but you need to comply with the requirement. And when it comes to travel expenses, these requirements are quite strict for SARS when it comes to the implementation or the claim of these travel expenses. What do you need to do? First, record your motor vehicle's odometer reading on 1st of March on the first day of the tax year, which is tomorrow. Go out, record it, best to take a photo. Second, make sure that you keep a logbook throughout the year. Note that it is not necessary to record details of private travel, but you must record details of business travel. You may make use of the SARS e-logbook. Simply download the link. I'll show you an example after this, what it looks like. Often people create their own logbook. It's no need for that. SARS actually provides you with a logbook because they know, look here, you can claim it. Here's a logbook. We give you the template. It's convenient. Just complete it and put in the accurate information so that you can benefit from this. The third one is record your motor vehicle's closing odometer reading on the last day of February of the next year, on the last day of the applicable tax year, which is obviously today. You need to record it. I would say best take a photo. Always take a photo. I've seen that most instances, people just estimate or they put in a figure. If you have a photo, SARS will most likely approve your claim. The fourth one, calculate your kilometers, total kilometers for the full year, closing kilometers less opening kilometers. And the fifth one is calculate your total business kilometers for the year, sum of all the business kilometers. This is quite important because this is what SARS will look at. What do I record in my logbook? Okay, so often you find people before filing season like, oh, now I need to do my logbook. Please do not do that. That is where you're going to make a mistake. That is where SARS will end up going back and forth and your claim will be rejected, because I can promise you they do sample testing. I've been on the other side. I've been that side. And yes, you provide a logbook that you created last minute. You're guessing, you're checking the route. SARS will do sample testing. And it always ends up the sample testing that they do is, if you say I go from Claremont to Cape Town, now the person auditing your matter at SARS, they're familiar with the distance, but now you inserted, say for example, it's 8 kilometers, you inserted 14 kilometers. they will go and sample test that particular method. They will go on Google Maps. I can I promise you this is part of what I did as well when there was a legal dispute and I had to assess the case. You go and you sample this, like what is the distance from Claremont to Cape Town? But this person, okay, it is 8 kilometers, but perhaps there was traffic that day and the person took a different route. Then they will check if it does not match up. If one of those things does not match up, your entire logbook will be rejected. So make sure that you keep accurate record of these things. So in respect of every business trip, you must record at least the following: the date that you travel, the kilometers traveled, the business travel details, where you started your trip, and where you went and the reason for that trip. That is important to record. That is what they look at, and they will ask you, what is this? What did you go do? And you cannot claim for traveling from home to office. That is not a claim. How do I work out how much I can claim? There are two ways of doing it. The one is calculate your claim based on the cost scale table, which is SARS applies in the logbook. This table is available in the logbook. I'll show you when I'm going to show example of the logbook. And then you have calculate your claim based on actual costs. To do this, you'll have to keep accurate record of all your expenses during the year. In addition to keeping a logbook, these expenses include fuel, oil, repairs and maintenance, car license, insurance, wear and tear, and finance charges or lease costs. It's important, I believe, or from my experience, the actual cost is the best way, but it just comes with additional admin that you need to go through and to keep record. Before we go to the next one, I just want to show you what the logbook looks like. Sorry, I'll just switch off my camera for a moment. Okay, so this is basically the SARS logbook that's available online. If you need us to provide you with a copy, please let me know, and we can certainly share that. You can just email tax@stbb.co.za. Alternatively, it's also available on SARS website. So basically, this is the logbook. SARS Travel, it's quite convenient. You insert the date, you go over opening, closing, and it will calculate everything for you. So there's formulas incorporated in this logbook that you can make use of, and it makes your life easier. It becomes a bit burdensome when you need to do it every day, but I would suggest that at least try to do it once a week, or however you feel best suits you. Is have this open on your desktop. If you did any business traveling for that day, insert it, get back, insert it, put in the reason. You don't want to rush the last minute to prepare a logbook and then end up putting incorrect information. Your claim will be rejected. This is something that can benefit you, that can benefit your ultimate tax liability. So with SARS, always the best step: keep accurate record of your expenses, of your matters. That is how you will be able to achieve and reap the best tax benefits that's available for you. It's not that SARS is just after wanting your tax. They actually have available benefits for you. You are just not doing the necessary things to be able to reap these benefits. So I'll just switch off my camera now to go back. So this is basically one of the ways of how you can benefit from the logbook, from the travel allowance expenses, etc. And solar tax incentive. This is also one that most people will claim this year, deduction available to part people, to taxpayers. You know, the song by I'm not particularly sure the name of the song, but Darkness My Old Friend. Clearly in South Africa, darkness is our old friend because of load shedding, and SARS came to the party and they provided with a 1-year solar tax incentives. Unfortunately, that incentive is coming to an end today. Today is the last day of this incentive be in existence. And if you did in any solar at when off the grid, etc., you may be able to claim this in your tax return this year, provided you comply with the requirements. So what is the requirements? The qualifying criteria for solar tax incentive is that only new and unused solar PV panels qualify. The panels can be installed as part of a new system or as extension of existing system, but it needs to be new and unused. Any solar PV panels with a minimum capacity of 275 watt per panel designed output qualify for this rebate. So it's not any solar panel. Just because you installed new solar panels doesn't mean you will be entitled to the solar tax incentive. There's certain requirements. Other components of a system, batteries, inverters, fittings, or diesel generators, and installation costs do not qualify for this. Portable panels will also not qualify. We will get onto the reason why portable panels will not qualify, but basically the law said it needs to be installed. It needs to be fixed. Solar PV panels must be installed at a residence that is mainly used by an individual for domestic purposes. So once again, SARS tricky with the words that they use in the law. For example, the first one, it needs to be a new and unused solar PV panel. So it's not any panel. SARS will focus, if you claim this is where SARS will look at, is this a new and unused solar PV panel? We're touching on the topic now of the PV panel must be installed at a residence that is mainly used by an individual for domestic purposes. So people often, what does mainly use? When you deal with SARS, mainly means anything more than 50%. It cannot be 50-50, it needs to be more than 50%. So if you do not use your residence mainly for domestic purposes, unfortunately, you will not be able to claim this. The installation must be proved with a certificate of compliance in terms of the Electrical Installation Regulations 2009 to ensure the safety of the installation and compliance with the regulations. SARS will request a copy of the certificate as well. The solar PV panels must form part of a system that is connected to the mains distribution of the private domestic residence. And then the rebate applies to qualifying solar PV panels that were brought into use for the first time in the period from 1st of March 2023 to 29 February 2024. So this is a very funny requirement that SARS inserted. Not funny, but it actually benefits people that purchase solar PV panels that meet that satisfy the other requirements, but they've never used it for the first time, although it wasn't introduced, it was brought into use for the first time during that period. So if I purchase my qualifying solar panels before the 1st of March 2023, but I only brought it into use during this period, I will most likely qualify for the tax incentive. So let's do a case study to explain the requirements, the inherent requirements of the solar tax incentive. Homeowner is purchased 2 solar PV panels in 2019 to alleviate load shedding challenges. These panels were immediately installed and brought into use in 2019. In 2020, S purchased 3 pre-used panels from a company which was liquidating and had no more use for the panels. Owing the size of the battery and the inverter, only 2 of these panels were installed. Homeowner S upgraded the solar system in April 2023, which entailed the purchase of an additional battery and 3 more panels. Of these 3 panels, one had a generation capacity of 250 watt, and the other 2 were 280 watt. All the panels, including the one which was purchased but not installed in 2020, were installed and brought into use in May 2023. Homeowner S wanted to claim the tax credit for the 4 panels installed and brought into use in 2023 against normal income. What's the result? The panel, which was pre-used, acquired in 2020 and remained uninstalled until 2023. This panel did not meet the requirement under Section 6C, that is, the solar panel, PV panel, was not new and unused. Panels which were purchased and installed in 2023, these panels complied with the requirements new and unused and brought into use for the first time by that taxpayer on or after 1st March 2023 and before 1st March 2024, which means today was the last day, 1st of March would be tomorrow. However, the generation capacity of these panels had also been taken into consideration. So let me just move this up. Consideration, in terms of the set section, each panel must not be less than 275 watt. Two of these panels had a generation capacity of 280 watt and the other one 250 watt. The latter panel thus did not meet the requirement as of 275 watt. As such, homeowner S could claim the tax credit relating to the two qualifying panels only. So you can see from that example that it's not, you need to satisfy every single requirement in order to be able to qualify for this solar tax incentive. And the only way of you making use of this is by providing proof of these things and meeting the necessary requirements. So what's the allowable amount of tax credit? Individuals can claim a tax credit of 25% of the costs actually incurred on the solar PV panels, up to a maximum of 15,000. This credit is deducted directly from the individual's tax liability, providing a significant incentive for investing in solar energy. So basically, it is going to reduce your tax liability. And if you can claim up to 15,000, paying less tax wherever you can save, it's a benefit. For example, a person buys 10 solar PV panels at a cost of 4,000 per panel, totaling to 40,000. That person will be able to claim 25% of the cost up to 15,000, so 10,000. A different person is able to buy 20 panels at a cost of 4,000 per panel, which totals up to 80,000. The calculations of 25% adds up to 20,000, but they can claim 15,000 max. So it doesn't matter how much the 25% adds up to, you are capped at 15,000 rand. Individuals claiming the tax credit under Section 6C must ensure their income tax returns accurately reflects the installation of a new and unused solar PV panel. Details such as connection to the residence distribution board, generation capacity of the panel, etc. As we discussed, you need to provide the proof of this of these requirements. You need to satisfy the requirements. Going back to, in terms of the Tax Administration Act, the taxpayer pays the owners of proving that they incurred or they satisfy these inherent requirements. So a natural person claiming a tax credit under Section 6C may have to confirm the following information on their tax return: the number of new and unused solar PV panels installed during the period. The panels are connected to the residence electrical distribution board. The minimum generation capacity is 275 watt for each solar panel, not collectively, each solar panel, and the total legitimate electrical limited compliance certificate, essentially. That is what you will need to submit to SARS if you wish to make use of this solar tax incentive. It is a 15,000 rand to be deducted from your taxable income is quite substantial. So if you can gather this information, make sure that you comply with all of these requirements before you submit your tax return, please do so. This is another benefit that's available to you, provided that you meet all the necessary requirements. So let's get to moving on to capital gains tax. Capital gains tax is the tax that you pay on disposal of property where you made a profit. The reason why we're touching on this particular topic now is every year, come February, January, my mailbox I'm sitting with a number of emails where clients want to know, when am I liable for capital gains tax? You are liable for capital gains tax in two instances. The capital gains tax is triggered on the disposal, but the time of disposal is determined with respect to two events. When we're dealing with immovable property now, there's two events. So basically, the time of disposal holds a significant role in determining capital gain or capital loss should be accounted for. This principle plays a crucial role in the tax treatment of the transaction involving immovable property. The time of disposal in relation to sale of immovable property is either the date on which the agreement of sale was signed, or if there's a suspensive condition, the moment the suspensive condition stipulated in the agreement of sale has been fulfilled. SARS acknowledges that transfer of immovable property is realized upon its registration with the deeds office, but this is not the date that CGT is triggered. That's not the time of disposal. Time of disposal happens when you either sign the agreement of sale where there's no suspensive conditions, or if there's a suspensive condition, upon the fulfillment of that suspensive condition. So, for example, I'm signing my agreement of sale now, I'm the seller, the purchaser is getting a mortgage bond. We sign on the 1st of April. The mortgage bond is only approved on the 20th of April. The 20th of April will be the date, will be time of disposal, which means the date that CGT is triggered. In the event that is the other suspensive condition is where I sell my property, I sign the agreement of sale on 1st of April, it is subject to the purchaser selling the existing property. That is another suspensive condition. So CGT, time of disposal will be the date that individual, the purchaser, sells the existing property, and that will also trigger CGT. So CGT is triggered in two instances, either the date that you sign the agreement, and that is the last signature to the agreement, or the date of fulfillment of suspensive conditions. I've seen people get creative and try to create suspensive conditions. Please note, it's not a suspensive condition is not anything that you can insert in the agreement and say, this is a suspensive condition. I will only, the seller will need to change the window frames or will need to change the doors. That is not a suspensive condition. Has been these court cases where the courts have discussed this matter, and they've said that a suspensive condition is the condition that suspends the contract in its totality. So what that means is that it is something that is an uncertain future event, and it suspends every single thing in the agreement until that's uncertain future event has been fulfilled. So when you say, let's put a clause to say that in new wooden floors, for SARS purposes, that will not suffice as a suspensive condition. They are very strict when it comes to what is a suspensive condition. And I can advise you now, in most instances, the typical suspensive conditions acceptable by SARS is where there's a mortgage bond or where they are required to sell the existing property. But that suspensive condition should suspend the contract in its totality up until the fulfillment of that uncertain future event. I would say that, for example, getting building approval, because if I don't get building approval, I will not. That suspends the entire contract as well. That can, to some extent, can also be considered, but it needs to be on a case-by-case basis, and that can be inserted, which will suspend or defer the time of disposal. So it's important that you understand, if I sell my property, if I sign an agreement on 15th of February, and there's no suspensive conditions, and we're transferring now in July. Time of disposal, tax period is in the tax period where the agreement was signed, not in the when the transfer took place in 2024-2025 tax period. It's in the previous period. And a lot of people sit provisional taxpayers, etc. They sit with a problem where transfer is not taking place now. They're not getting the money, but they need to account for the CGT. Unfortunately, there's no other alternative way around this. The CGT is one of the areas where there is a little loophole or room to move around and to maneuver it. It is one of the most advanced provisions in the act that covers most instances. Even, for example, when you an option contract, had a discussion with another colleague of mine during the week where they want to do an option contract, but that granting of that option is also a time of disposal. There's also CGT implications. Then we look at a non-refundable deposit. Unfortunately, if you have a non-refundable deposit and the suspension is not fulfilled, although you insert that the agreement of sale is subject to the purchaser securing or selling the existing property, and then but the person paid a non-refundable deposit, and the person within the time frame they were allowed to sell the property doesn't get to do so. Suspension of condition not fulfilled, agreement is null and void, but then there's a non-refundable deposit. Please note that non-refundable deposit, this CDs closing of that right at a no base cost, and the person acquiring that right is equal to the value of what that non-refundable deposit was. So if it's 2 million, the base cost will be no, the other one will be 2 million. So be very mindful when you insert clauses into your agreement or when you discuss, you need to take into account the CGT implications and all those additional things, the period for transit duty, etc. These various things that you need to take into account when you sell your property, especially if you are busy signing a deal closer to the end of February because you are now moving into another tax period. So be mindful of the terms in your agreement, consult, approach our STBB to look at the agreement for you, and we'll gladly do so. Let's make sure that you are in the best position from a tax perspective and that you are not putting yourself in a difficult position when you account for CGT when you not even in possession of the funds yet because you're only entitled to those funds on date of registration of transfer. So we will now look at a simple, if you disposed of your property during this the tax period that's ending today, last tax period of 2023, 2024, you will need to do some calculations and account for your capital gains tax. If you're non-resident, this most probably we're going to discuss the tax directive, but this is what essentially what capital gain calculation looks like. So what you see in front of you is a typical table of how do I calculate what my gain or liability tax CGT liability is, and how much am I supposed to include in my taxable income. So the scenario, purchase price 2 million. So you purchased your property in 2015 for 2 million. You had agent's commission of 100,000, transfer costs, acquired the property for 200,000. That forms your base cost of 2.3 million. The base cost essentially is the term used that encompasses not only the cost you paid for acquiring the property, but the expenses you incurred in disposing of the property. So that's why you have the agent's commission included and the transfer costs when you acquire the property. You can also include expenses incurred for capital improvements done to the property. So when you say capital improvements done to the property, often when I mention this to clients, they email me a substantial amount of invoices and say, well, yeah, we've done renovations to the property, we've done A, B, and C. Please note, it needs to be capital improvements, capital renovations, something that changes the structure of your house, the building. And if you send the invoice or you want to include for painting, unfortunately, it cannot be included. It is also on a case-by-case basis. But if you look at painting, that is maintenance. If you look at there was a plumber had to come out to do certain things, that is maintenance claimable against rental if you rented out your property, but not allowed for capital gains tax. So it needs to be costs incurred for attending to improvements of a capital nature. So I always say, if you want to understand it, look at, did it add value to my property? Did it change the structure of my property? In layman's terms, very difficult for a person not familiar with the tax requirements to understand this, but I simplified, did it change the value or did it increase the value of the property? Did it change the the nature of the structure of the building, in that instance, yes. But furniture, painting, typical maintenance, not allowed to be included in your CGT calculations to form your base cost. The other thing that's also allowed is if you had to defend your title to your property. For instance, there was a dispute about your property, you had tenants, you had to get them out, etc. You were defending your title to your right or entitled to that property. The cost you incurred can also be included. Something that I see a lot happen is that people want to include bond registration costs, bond costs. Unfortunately, that is not allowable expense or allowable expense to include in your capital gains tax. It is set off during your taxable income, the interest that you pay, etc., or even when you do your rental. So it's bond costs is not allowed for CGT purposes, and that basically forms your base cost. So your base cost less the proceeds. So you're selling your house for 4.6 million. There was a gain made on that property of 2.3 million. So that's your gain. If you are South African and you occupy your property as your primary residence, please note, just because you own one property in South Africa, if you're a foreigner, in instance where you live abroad, and you only own one property in South Africa, that is not your primary residence. It is not the fact that I'm primary residence doesn't mean if you own one property, that is my primary residence. Primary residence, in terms of the narrow interpretation, which is how SARS exercises subject to certain exclusions. Where do I go to after I leave work today? I go to my primary residence. Where do I go to? Where do I spend on weekend? The place that you go to, that you call home, that your utility bill is sent to, that is your primary residence. You need to occupy that property as your primary residence. There's certain exclusions, or where it is that you are traveling or you travel a lot for work, etc. There is exemptions in that, in terms of the narrow definition of primary residence. But primary residence is not centered around the fact that I own one property and that is my primary residence. That is not the case. It is you need to occupy that property as your primary residence. Based on what you see on the screen, if you occupy the property as your primary residence, you would have been entitled to a 2 million exclusion. Every person gets a 2 million exclusion in respect of their property. But please be mindful, if you co-own the property, husband and wife co-own the property, the 2 million exclusion is apportioned to your the ownership percentage. So if two people own the property, that 2 million becomes 1 million. And if you occupy the property with 4 other people, is now divided between each person according to their ownership percentage in the property. Another thing on that is that some people occupy the property for years as their primary residence, and then they left the country or they moved into a different property and now they occupy that property as their primary residence. You are entitled under certain circumstances to apportion your primary residence. So what that means is there's a certain calculation that we do. It is we take the amount of years that you've occupied the property as your primary, the amount of years that you own the property, and take the amount of years that you occupied as your primary residence. Then you get to the actual amount that you're allowed to take from the 2 million. So it's not a blanket 2 million. There is sub requirements. And when you do it, if you do your own taxes or if you sold the property, please bear this in mind when you do your tax return and you want to submit it. It's not a blanket 2 million exclusion. It's all dependent on whether you occupy as your primary residence, whether you are the sole owner of that property, etc. And when it comes to non-residents, if you occupy your property as you occupy the property, you live in South Africa, you occupy the property as non-resident, as primary residence, and you leave the country now, and now you become a non-tax resident for South Africa, you sell your property, you paid your exit tax when you left, your immovable property, you don't pay exit tax when you leave. At that point, you pay it later when you dispose of it. And now you want to claim your primary residence exclusion. Please note, SARS cross-examines the period that if you say I occupied my property from 2010 until 2015 as my primary residence, SARS will cross-examine that period with your entry and exit with customs. So they will look at when you entered South Africa, when you exited South Africa, and if you taking a chance to submit, okay, I'm going to say I occupied it for X amount of years. SARS, they do a due diligence, and the customs department will be contacted to verify your entry and exit in terms in and out of South Africa. I'm not sure, there was a year and a half ago, so there was also a discussion around the travel permit that you will need to get, South Africans need to get when they travel from SARS, etc. I think they started rolling it out in Kinshasa. I'm not sure about how well it's going at this point in time, but that travel permit that you're getting is also going to be able to track when you enter and exit the country, and when you cease to become a tax resident. And upon cessation of tax residency in South Africa, you become liable to pay exit tax on your worldwide assets. So just be very mindful, if you tacitly or by operation of law become a non-tax resident, that you will become liable for exit tax. And if it's been 10 years since you became a non-tax resident, you will need to pay penalties and interest, most likely, because the payment should have done 10 years ago. So be very mindful about that when you decide to relocate. Rather formalize your financial ties with South Africa. And when I say ceasing to be a tax resident, you are not ceasing to be a South African. You are just cutting your financial ties with South Africa, and you become a tax resident of another country. Deviated a lot from what we are kind of discussing on the screen, but that is primary residence. And then each person is also entitled to an annual exclusion of 40,000 that will be deducted. You eventually get to a total capital loss. If it was the primary resident included, there will be a capital loss of, if we insert the primary resident, it will be a capital loss or capital gain. In this instance, it will be a capital gain of 2260, and then only 40%. So this is where, when I started, I spoke about the CGT rates. Only 40% of the gain is added to your taxable income. What this means, you will take the 2.260 amount, and you will times that by 40, and that will give you the actual gain that is added to your taxable income. Meaning, as I said, CGT is not a separate tax. CGT is a tax, it's added to your taxable income, and often it happens that it pushes you up into a different tax bracket, which means this year you're paying, for example, say you've always been in a 36 percentage tax bracket. This year you dispose of your property, surprise, you most likely going to be in a 45% tax bracket at the end of this year because of that amount. So it is not a separate tax, it is it forms part of your taxable income. Once you've established that, you add it to your taxable income, and then you go down to your marginal tax rate. So this is a brief, simple example of what a CGT calculation would look like. So now we get into withholding tax. Withholding tax is a provision that was inserted into our fiscal legislation by SARS. They wanted this provision in because of the fact that if you take a non-resident, I'm a non-resident, I don't live in South Africa, I don't work in South Africa, I come to visit here, I enjoy coming for a long break, staying in Cape Town. I have no other financial ties to South Africa. I bought a property here to make my life easier. I get rental income. They're supposed to submit tax returns. So, but you never know. So now SARS said, okay, they have no financial ties to South Africa. They are a non-resident for tax purposes. How can we make sure that we collect the CGT from them should they dispose of their property? What happened? Withholding tax was introduced. What is withholding tax? Withholding tax is essentially a provision captured in Section 35 Cap A of the Income Tax Act that stipulates that if a non-resident disposes of a property, the conveyance, I'm summarizing this, not exactly the words as in the act, but I'm summarizing it for you to simplify for you. The conveyancer is required to withhold the prescribed rate. And the prescribed rate is 7.5% for natural persons, 10% for companies, and 15% for trusts. they need to withhold that amount and pay it over to SARS as it's deemed to be a provisional payment to SARS for that non-residence withholding tax. The obligation is imposed on the estate, on the conveyancer and or the estate agent. The Act states that it is on the purchaser, but it further have sub-inherent requirements that speak to or the person that's holding the funds or the person making the payment. So we all know when you sell a property, you pay the proceeds to the conveyancer, the conveyancer's trust account, where the liability shifts in that instance. So that is why you are required as the conveyancer and or estate agent to withhold that amount and pay it over to SARS. That is if the non-resident did not opt for tax directive. So what is a tax directive? A tax directive is essentially a mechanism available that was inserted in the Act as well. It's a mechanism available for that non-resident to be able to apply to SARS for a tax directive to find out, listen here, I sold my property and I don't want 7.5% to be paid over to SARS because the 7.5%, I forgot to mention this earlier on, is not calculated on the gain. The Act, Section 35, Cap A states it's calculated on any amount payable. What that means, it is calculated on the selling price as captured in the agreement of sale. Often I get it to where people say, no, it's a gain. And I need to explain to them. Section 35 is in the sections of the Act, whereas capital gain tax is under the 8th schedule. That's weird. Two different sections, two different areas in the Act where you will find it. And the mere fact where it is located in the Act will tell you what you need to look at. There's a reason why it's not under the 8th schedule. It's under Section 35 Cap A. It's because the purchase price is not the withholding tax is not calculated on this. The gain is calculated on the the selling price as it reflects in the agreement of sale. And you can imagine if you've lost on sorry for that. So, okay, sorry, I'll just get it up that I'm taking too long. I'm speaking a lot. Sorry, I just get excited when I speak about tax, but I'll speed up. So basically, withholding tax is a provision inserted where non-residents are required to pay over to SARS 7.5%, 10%, or 15%, depending on the nature of the entity, to SARS, and this obligation rests on the conveyancer and or estate agent. And if the conveyancer and estate agent do not pay this over within the prescribed period, then what happens in that instance is the conveyancer becomes liable and the estate agent for penalties and interest, which will accumulate from the date that it was due and payable. Please note that SARS can then recoup from you the fees, the maximum amount of fees that you receive from this transaction to cover the expenses. And then with the estate agent, the commission they receive. So what that means is to be proactive. If you're a estate agent online and if you're an attorney not at SB or even at SBB, please pay attention to your tax residence status of your client when you receive a transaction. I'm speeding now because I've been speaking way too much, but essentially we can provide the services of applying for tax directive. And that essentially means that the client will pay only on the amount as stipulated in terms of the tax directive issued by SARS. We do have a fee for that. If you do have any questions around tax directives, etc., you can contact me at tax@scb.co.za. And we can assist you if a non-res wishing to purchase property and want to know more about tax. Please contact me. We will gladly assist you. If you're a non-resident owning property in South Africa and and don't have a South African will, please contact estates@sv.co.za, and the same with your trust as well. Before you decide to jump on the wagon and create a trust, consult, do estate planning. We are doing even we have a range of services at SCBB. Make use of our one-stop service, and also download the app. Phenomenal system gadget to have at your disposal. It will help a lot. But please, thank you for joining the webinar. I know, Liani, I'm going to go hand over to you now. I've been non-stop speaking. So thank you, everyone. Hope you have a lovely day. If you have any queries, please contact me at tax@scb.co.za.
Thank you so much, Mon, and thank you for all the questions that were shared. Mon, thank you for being so passionate about tax. I'm sure everyone really enjoyed it, and I must say you made the practical implications of it quite easy to understand from everyone's point of view, I'm sure. And I think the song you were looking for was The Sound of Silence. So, but thank you everyone for joining us for in today's session. And as Mon said, we'll be sharing with you all the notes afterwards. I'll be sharing the recording. You'll get your certificate, and then also we'll be addressing all the questions that were shared. There were some very interesting questions that. So we will definitely be sharing those with you. And then please be on the lookout, because I think we might be probably be doing a part 2 to this session, specifically pertaining again to the capital gains tax, withholding tax, and the tax duties that go with that. You're also more than welcome to have a look at our STBB Direct app that you can find on the Google app and the Play stores, that also have a very simplistic way of calculating your capital gains tax, even though you would still have to reach out to your to say Aman at tax@STBB to help you with that specific calculations on your capital gains tax. So thank you once again to everyone. I'm looking forward to seeing you at our next webinar this coming month. That will be all about matrimony matters and the matrimonial properties and the different regimes, and also the implications that has for the various parties involved. So once again, thank you everyone. You can see the contact details on the screen, and I hope you all have an amazing Thursday and a Friday and a good weekend.